So Nathan, thanks for jumping on. Trey Galuppi from TRA, and then I'm also Ikesh Liga from the Standard. So reviewing the basics, let's start with that. Nathan, would you please tell our advisor partners on the line what the basic requirements are for audits? Let's start with that.
Yeah, and this is a more fun question than usual because some things have changed very recently. I know many of you advisors out there probably are aware of that, but basically, the threshold between a small plan and a large plan is 100 participants. If on day one of the plan you're over 100, you're technically a large plan. If you're under 100, you're technically a small plan. Now, before I get into some of the caveats to that, the change I'm referring to, which I'm sure many of you are aware of because you probably have some clients that are going to be helped with that. But the Department of Labor has changed the methodology for how they're counting a participant starting January 1, 2023. And so in the future, a participant is just going to be someone who has an account balance in your plan. And in the past, all the way up till now, it's been someone who has an account balance in the plan, whether they're existing or terminated, as well as any active employee that's eligible to contribute to the plan. And so you've probably seen many 5500s where you've got 50 or 60 participants in the plan as far as accounts, but you've got like maybe 140 participants officially. So that's changed. So that's actually going to evaporate about 20% of the audits next year. Something we've been contingency planning for a little while, because we kind of expected this to come down the road. So that's kind of a little caveat for what's changed if you're used to how it works. But there is this thing called the 80-120 rule. It's basically that if you have been a small plan for some years, you can actually go over the 100 count and still file as last year. As long as you're over 100, under 120, you can file the same status you were last year. So if you're a small plan last year, you can go ahead and keep filing as a small plan as long as you stay under 120. Now that's going to be more interesting. We're going to talk about in a little bit about ways to try to keep your clients out of audits. And that's definitely one way as an advisor that you can show your value is if you can keep your client out of an audit, that's something your client will really appreciate you for. So we'll talk a little bit about that, and it becomes even more important with this sort of account balances notion that the DOL has put into play. Real quick, too, another pocket move you can have is if you've got a plan year, either the one that you're currently looking at or the previous one, if it's less than 7 months, you can actually punt that into the next audit. So if you've got a plan that say started up in August, they're going to have a short plan year. You can actually punt that audit into next year and say, we'll do that when we do next year's audit. So then you can wrap them up both at once. And there's kind of a little checkbox for that. Governmental and church plans, it just really depends. But most of them are going to, a lot are not going to be under ERISA, especially the church plans. I think that's all I really want to say about this. Auto requirement for startup plans, that's a question that does come up sometimes, is if that 80-120 rule, it doesn't help you if it's your first plan year. So if you're at 101 on day one of your first plan year, then you're going to be facing the audit that year. So that's a little caveat. You don't get the 80-120 rule in that case. That's all I have on that. I think a lot of you are probably familiar with some of this, but pay attention, look at those 5500s and pay attention to what account balances you're looking at. You might have some clients that don't need an audit next year.
Awesome. Thank you, Nathan. Well, and that was for single employer plans. Now, we've been talking a lot about PEPs these days over the last few years. When does a PEP need to be audited, and what are the procedures for that?
Yeah, so the PEP is a fun one because it has a slightly more nuanced definition of when it gets audited, but still benefits from this new participant counting methodology. But basically, your PEP's audited either if you've got over 1,000 participants in the PEP, or you have a single employer that itself is over 100 participants. So the idea is if you've got one plan in there that would be a large plan on its own, the PEP needs to be audit. Or if you have a lot of small plans, but they all amount up to more than 1,000 participants, then you'll be subject to the audit as well. In the PEP plans, it's, this is an interesting new territory for audits because, really haven't been, PEPs out there to be audited. We have an analog to some of the open MEPs and some other multiple employer plans and things like that. So there's some analogs to it, but one of the things we have to kind of think about is there's definitely some streamlining of processes, especially if there's centralized administration of like distributions and loans and all that kind of stuff. We can kind of get some efficiencies from looking at that across this broad spectrum. And, you only need to sample up to a certain point and you've got some good statistical coverage with a very large population. Where it gets a little more interesting is scoping around the different employers in the plan. And that's going to look a little different in each PEP because some PEPs are going to be maybe dominated by one large employer and then a bunch of small guys. And we kind of want to not have anyone with a zero chance of being audited. But most of the time, you're going to be focused on that big employer and then picking up some small ones around. And then, there's a lot of different nuances as far as how you're processing contributions. I would say if you're involved in setting up a PEP, anything you can do to centralize things, to standardize things, is a huge benefit to the audit. That is something that can allow us to really get the economies of scale you want. If everything is balkanized and just, everyone's doing a little bit different, then we have MEPs in both worlds. We have MEPs that are very centralized and they can be very efficient, and others where you almost have to do things differently for each employer, and that is not as efficient. So if you're involved in setting up a PEP, definitely keep that in mind. Anything you can centralize, getting them on the same payroll, getting them on, definitely processing contributions in some sort of, uniform way. Anything you can do to kind of get that so that the auditor can take advantage of the economies of scale will be good plan design there.
That's really helpful. Thanks, Nate. So, evolution of the audit landscape. Trey, question for you. Start us out. What are you seeing out there with your clients with all the various legislative changes that we've come down the pike over the last few years?
Yeah, I mean, in all honesty, because of the newer audit changes and some of the other efficiencies that we look at on a broader scale, we're starting to see more of the PEP space becoming, and I don't want to go so extreme to say it's an institutional product, but you're seeing a lot of large employers gravitate towards the PEP that are actually getting the true benefits of what a PEP can actually bring from an audit consolidation perspective. When we look at some of the smaller plans that initially had joined into PEP markets, it was, for a liability shift in there. But the type of bullseye that they become from a DOL perspective and an IRS perspective is a little bit more minimized at this stage, where they don't have the assets to create that big target on their back. They don't have the size capacity to also create kind of that other target on their back from IRS or DOL failures on that sense, and being randomly audited from that perspective. And then when we look at the element of fee subsidization within a PEP, just as Nathan had alluded to earlier, some of the PEPs that we're seeing are having, one larger adopter and a bunch of smaller ones. It's somewhat impossible not to have an element of fee subsidization within those confines of that structure, right? Because you're looking at, different smaller employers that don't need an audit on their own requirements, but are paying a percentage to a degree for an audit within this PEP, platform that they're actually in. So it's hard for large adopters that are not all sharing those PEP audit costs to find value in there. that actually is not having their assets carry the weight for some of the asset charges for the smaller plans, or some of the smaller plans carrying the weight for the audit costs of the larger plans. So what we've been seeing in the space recently is a separation, two different types of PEPs, one for smaller markets that are looking to create that higher level of fiduciary outsourcing, and then one for large plans that are looking to consolidate an audit cost when they're all auditable to begin with.
Awesome, thank you. And Nathan, question back to you. What are you, and again, with the evolution of, all these legislative changes over the last few years, what are you mostly looking for in your reviews these days?
Yeah, I would say not only legislative changes, but also there's been some evolution in the auditing standards as well. So some of you might have heard the words SAS 136, which was a new auditing standard that came out a few years ago. It got deferred for a bit due to COVID. And then last year was the first full year of required implementation. What SAS 136 does is basically take the general auditing standards that we've always sort of tried to adapt to ERISA plans, and it clarified how those standards apply to specifically to ERISA audits. And so that was actually one of the auditing standards updates that was helpful. Usually they're just a pain in the neck because they just put more requirements on us of what we need to do. But that one was actually helpful because we've kind of argued with people for years about what our views were as far as how the auditing standards apply to ERISA plans. And SAS 136, I think, largely validated a lot of the conclusions we had reached as a firm. So it was nice to have it finally in print. The main upshot of that is, some of it is just terminological, really. The limited scope audit, which I know we've all heard, that's if you got, a large institution that can provide a certification to the auditor, we could scope out the investments and the related earnings and things like that, and we could just remove those from the scope of the audit. It still basically works the same way, but they have changed it to what's called an ERISA 103A3C audit. I guess the idea was that limited scope audits, no one understood what they were. So calling them ERISA 103A3C makes it so much more clear. And so basically it's the same thing, but they did a little bit of, it's some semantics, but it's not really considered a limited scope audit. It's considered to be a special type of audit for ERISA plans. And so the type of opinion we issue is no longer a disclaimer of opinion, but it's an actual unqualified opinion. So I know some clients appreciate that. And if you ever actually taken the time to read a limited scope audit opinion, you probably would come away thinking, so what exactly did you guys do? Because it kind of sounds like we didn't do anything. And so that's sort of changed in the opinion's about 4 pages long. It used to be about 2. So that's all sort of changed. So I don't think if your auditor was doing what they should be doing, SAS 136 changes a lot of what's going to happen on the ground as far as the audit works. So the other thing, CARES Act is on here. I think what we're kind of finding is that everyone kind of just ready to be over COVID. And, the CARES Act amendments have been, you basically almost have eternity to get those done. And as far as an official amendment and things like that. So we've actually been advising clients to just even remove those extra. We had a bunch of extra disclosures during COVID, like, there's a pandemic, make sure you don't forget to mention that. Now, like, everyone's just really, we're finding over it. And so I think that's kind of gone by the wayside. But I think the last thing I'd say is that another kind of rule change is, I think maybe a couple years ago now, is the IRS had some changes in impacting hardship distributions and sort of the plan administrator's responsibilities around it. And that's changed kind of how we operate as auditors. It used to be kind of saying, okay, where's your supporting documents? Did you get supporting documents? Did you get the affidavit, et cetera? Now that's really changed to this self-certifying environment. And so we've actually kind of backed our audit teams off of hardship procedures, just make sure that hardships are allowable in the plan, make sure that they've got a self-certification process in place, but we're not chasing down supporting documents. There are different auditors who have taken different takes on that. I kind of disagree with them. Some have said that, this actually raises the burden because there's this idea if you were audited by the IRS or someone else, they could compel you to go and get the participant to give you the documents. But really, if you read the IRS rule, it really clearly states that they're reducing the plan administrator's burden there. So if you have an auditor that's giving a client a hard time, I would actually pull up the IRS rules and give them some quotes. Might help the client out there. So
that's really helpful. Thank you. So Nathan, could you talk a little bit about this slide? And I know you mentioned there's been a change, so this number will probably go down right next year.
That's right. Yeah. So we're kind of figuring out what this looks like. We call this the plan auditor universe. And it's definitely going to shrink as far as the number of assets subject to audit. Actually, the dollar amount might not shrink that much because it's going to be a lot of smaller plans are going to drop out of the auditor universe. But the numbers of these plans, I think we've been seeing something like potentially 16,000 to 20,000 plans that will, evaporate overnight. So I think these are, a few years old, but roughly where things are at. I think the little gray circle there is the number of CPA firms performing EDP audits. You may have even seen this out in the field, but that number's probably shrunk, maybe by 1,000 firms, even over the last few years, because a lot of smaller practitioners have been getting out of the specialization. There's been some consolidation. I don't think that really accounts for a big drop, but there have been a lot of firms just say it's not worth it to do ERISA audits anymore because there's a lot of scrutiny around ERISA plan auditors. It seems simple and low risk, but there's a lot to keep up with. It's a kind of a full-time job to stay up with all the changes and things like that in specialization. So, I think that's just sort of looking broader at, what I do as an auditor, what advisors are doing. I think that the whole industry is sort of channeling towards specialization. And the specialists are gonna win out, and it's going to be too much to keep up with and too much risk if you're not.
And I think we'll see in the next few slides of why, when you're selecting an auditor, why that specialization is really so important. So next question. So let's get into the details. So leveraging the Form 5500. When you're, just meeting with a prospect, you don't know anything about them, pull up the Form 5500. Nathan, so timeliness of contributions, how can we leverage the Form 5500 to find out a little bit more about the plan? And then what is actually considered, a late contribution in your world?
Yeah, I'll start with the second question, which is, it depends on if you are in that small plan bucket or if you're in the large plan bucket that we talked about earlier. If you're in the small plan bucket, then you have a very clear black and white rule, which is a 7-day safe harbor. As long as you get the employee remittances in within 7 days, they're deemed to be on time. As the large plan, it goes into this murkier zone where they basically say, hey, it's as soon as administratively feasible, but in no event later than the 15th business day of the subsequent month. Now, what we've seen when the Department of Labor is out auditing clients is it never gets out to the 15th business day of the subsequent month. Maybe if you have a blackout notice, that sort of buys you some time and you can point to that. But usually they'll point to other contributions that you got in earlier and say, this shows that it's administratively feasible to get it in 3 days. This is 4 days. This is 5 days. These are late. So we've seen DOL investigators be rather aggressive, as far as calling contributions late. There's different views from the auditing community on this. There are some auditors that try to mimic the DOL, basically say, you know, the DOL would probably call this late, so we're going to call it late and force you to report it. It's a reportable transaction. If it's a late contribution, it's a prohibited transaction. Our view is we kind of have a side calculation we use called rule of thumb that kind of takes your own pattern, does some statistics with it as far as interquartile ranges, and then just basically says if you're within that, we're not really going to give you a hard time about it. If you're above it but less than the 15th of the subsequent month, we're going to talk to you about whether there are extenuating circumstances. If you say, hey, we did that as soon as we could, there were some things going on, we're not going to try to read the DOL's mind as far as how they would conclude on that. We just let our clients know, listen, these are outside of your regular pattern. This is how the DOL would probably think about it. Just be ready for them to have a different conclusion than we reached. And so that's what we try to do with clients, try to educate while not sort of taking this adversarial stance or, really kind of being, trying to pretend I can read the mind of a DOL investigator and what the judgment they would make. As far as this little piece of the 5,500 on the screen, there's a number reported on there. That's the amount of any contributions that were late that haven't been corrected yet. So a couple things that you might think about if you're advising a client, and this is where you can kind of show some value where, I'm not just on the fiduciary side, I'm not just on the investment side, I'm not just flying at this high level, but I can also just be concerned with critical operational concerns with your plan. And, it's not a lot of extra work, but just sort of looking at this and saying, I noticed on line 4A in your 5,500, you've got late contributions. Let's talk about that process. What's going on there where you're having so many that are late? And that could yield some really, common sense conversations as far as, what can we do with the payroll process to kind of get that? Is there a different, and then maybe they talk about their payroll provider. Maybe that's a chance to bring in one of your partners to get an automation going on. There's a lot of options that you're probably even aware of. And so just kind of noting this and being able to show some value of how you can help improve their plan operations to get them off, get this number off their 5,500. The other thing to be aware of that might be useful is that this number stays on here through the year it's corrected. So if you're kind of doing an end of year eval with a client and they've still got some uncorrected contributions, you might say, hey, you want to get these done and fixed by December 31st. So next year you can get these off your 5,500. Because this thing, I have on there on the bullet DOL investigator prospecting tool. It really is a metric that DOL investigators will use. They'll look, if you have a high number like this plan does, what they're doing, they're trying to find plans where they think there's going to be findings. And so if there's already late remittances, that gives them a good sense there's probably other things going on. And they've got kind of a twisted incentive system at DOL that encourages them to find plans that, have problems, and they get points, and, I don't know, they're getting moved to the better office or a vacation or something for finding stuff on your plan. So.
Perfect. Thanks, Nate. Super helpful. So definition of comp comes up a lot. So Trey, question for you for, specific to when you're setting up the plan document, how do you consult on the definition of comp and then reviewing ongoing, and then pivot to Nathan, like what are you looking for when you're looking at the definition of comp?
Yeah, so it's a few things, right? Understanding the employee's status in there, right? What type of employee and how they're categorizing employee on here will help us, make that determination on definition of compensation. We have employers that obviously pay out in a variety of ways, and 1099 and putting K1 pass through income inside of a 4 qualified retirement plan is very, very challenging to be able to do on here. When you go, and I'll just piggyback off of what we were talking about before within those audits, and the timeliness of this stuff. This also comes into play with this definition of comp, because we always try to address the elephant in the room right at the beginning on integration of the payroll, right? How easy is it for us to get the files? What we have found in the past was when a client is involved with that process, having to export, reformat, upload files, that tends to be the root of the evil of this, late contributions or errors in the remittance of it, right? Things missed. So we always try to remove that element of the equation and just integrate directly with the payroll provider on that software, so that we can pull the ongoing census files that we need to be able to verify eligibility, verify, employment status, pull, the actual reports to monitor eligibility requirements, and then be able to have those reports remitted in a timely manner when the actual payroll run is made, not a week later on the 15th day of the next month, and on anything like that. So it improves the timeliness. It minimizes the lost opportunity cost. Really has an array of benefits right there. But overall, it's the accuracy that's improved, which has the most positive impact on the ongoing file of that for the auditing group, right? That helps positively impact the cost of that audit. When Nathan and their team don't have to actually spend a whole lot of time chasing things down and extra hours and extra work and resources to sort it and organize it, the results are a better price and a more efficient type of audit that gets done. And so that all comes from this, this aspect of the integration of the payroll, right? Without having the client kind of going in there and manipulating it. When we look at what the definitions are for compensation and how those are addressed within these payroll files, it's based on how the plan document is going to be written and what type of compensation is allowed, permitted, or excluded inside of this, looking at everything from highly compensated levels to bonus availabilities in here, and how and what money will be included in certain calculations for profit sharing, for safe harbor, for regular matches, discretionary, anything like that, but also what's available in here for participants to be able to include, and keeping, heavy eyes on that to make sure that, limits are not reached and excess contributions are coming in, right? We want to be timely on those types of things so that there's not a refund at the end of the year on there. We tend to find that just annoys people, right? So if we can monitor this stuff on an ongoing basis, we are significantly more accurate with it. And, it minimizes the amount of problems that are caused by data, right? Making every advisor on this call's job substantially easier when, they're not having to track down and figure out why the data is wrong. When you have access to it automatically, then we know exactly that it's not in the data transfer. It's not in that, it's in something else that may have gone wrong with an input on there. And we can pinpoint that a lot quicker and keep the plan in compliance throughout the year, instead of going back a year later and trying to retroactively fix things. Send refunds back, adjust payroll at that point. So it's just it's kind of the tip of the iceberg when you look at definition of compensation and the timeliness of contributions, and you realize that everything spawns from that integration of payroll data. So I'm sorry, I didn't mean to go off on too much of a tangent right there, but Nathan, I know you appreciate those aspects as well.
Yes, you probably saw me vehemently nodding my head. Any time that you have the client manually involved in payroll, bad things are going to happen. So, that's again another way where you can get involved in process and really help your client out. And they might not know any other way to do it. If you've got partners that you can bring in and say, listen, let's get them set up. Let's get this plan operating so that they don't have to, do all these gymnastics with Excel sheets just to get contributions uploaded. And then, that sort of snowballs into everything else. You're getting a clean census and getting your non-discrim testing on time and all that kind of stuff. One thing I want to mention, and Trey mentioned it as well, is, think about those big comp codes, bonuses, commissions. These are the people who are probably involved at some decision-making level. So that could be hiring and firing. you know, these are the people we want to keep happy. And there's certain things that we do on our audits that really aren't huge audit risk things, but they are things that impact the C-suite people the most. And so, for instance, we look at match limit. It's not really a financial statement issue if the match limits are exceeded. But if you have someone making $600,000 a year, they're getting matched on all of that. That's going to lead to a refund at some point and make them really unhappy. And so, you know, these things, being on the lookout for the things that impact those people. So bonuses, commissions, as you said, maybe guaranteed payments or something like that, if they're trying to defer on those, making sure that that kind of stuff is handled right in accordance with the way the plan reads. And I would say, especially, you know, we've just gone through the cycle 3 restatements. Every time we have a restatement period, I've got clients who suddenly have a compensation error because something got changed. A different box got checked. They moved over to a different prototype. And now the plan's definition of compensation works, and it's differently than it has historically. And so that's where you can be some value add and say, hey, let's go through the plan doc and just look at your definition of compensation. Let's talk to your payroll people and make sure that's how it's happening operationally. And if you can, find a good, reasonable ERISA attorney who knows compensation. That's a good person to have in your pocket if you're trying to figure out how stock comp is supposed to work in your plan, things like that. That's a person that is nice to have to help you out. Or if you find your plan is out of compliance with that definition of compensation, I know a lot of lawyers who can write my clients out of that. And so, you know, get it fixed prospectively before DOL or other auditor comes along and says, hey, you've got a tax qualification issue here.
Great, super helpful. So next audit detail we're going to dig into. So Trey, non-discrimination testing, our favorite. How do you consult with your clients on failures, and any tips, best practices for advisors on the line with highly comps and all that good stuff?
Sure. So, I mean, these are always the most fun conversations to have, you know, about as fun as Nathan's team, you know, calling and telling them it's time to get ready for their audit again. You know, nobody wants to have a conversation about testing failures, right? So one of the things that we always try to do within, you know, understanding why a plan would have failed testing is in looking at, you know, what their objectives are. And typically our regional sales consultants are no longer called sales consultants anymore. They're retirement plan specialists, right? So they're going through and working extremely hard on making sure that these plans are set up on the front end so that they're not creating these types of issues on the back end, where usually when an issue is surfaced with most groups, it's a month or two after the year is closed. So you can't go back and then, you know, throw on a safe harbor because you're already into the following year. So the best way to really go about this is to do what's called interim testing on here. When you have any type of group that has come close to failing or is in that kind of gray area, to run an interim test midway through the year or towards the end of the year to get an idea of where they're at, right? Have those consultations ahead of time. We can do this, you know, on request for any plan. So any advisor that's out there, I would highly recommend, you know, taking a look at what those mid-year testing are going to look like to know that you need to have a conversation ahead of time. And then, you know, we obviously see the other end of the spectrum where groups are well aware that they're going to fail and just keep doing it every year. And you can't really change that. So, you know, I think it's more of finding out where you can create small improvements and efficiencies when companies can't afford to do a safe harbor per se, but, you know, don't want to continue failing. There may be other alternatives for them to be able to structure something within a profit share, within an auto-enrolled component in here, ways to really boost that up. And I think the advisor plays integral roles in that. From a administrative perspective, we can provide some guidance and kind of shine spotlights on that roadmap and say, hey, here's where you really want to focus on that would improve the plan a lot. Run the illustrations, run the projections to kind of show what this would do and the results of that. And it's just something that can't ever be overlooked. When they start getting into that gray area, it needs to have that conversation immediately, not after the year is already closed, where it's too late to kind of put something in for the next year.
Thank you.
Frustrating to highly comps. Yeah, I mean, you're right, though. It's frustrating to the highly comps. I think we're always concerned about the key employees and the ownership side, but the highly comps are usually the ones that are just kind of the innocent bystanders in there that have to get some money back. So when they start getting frustrated, they complain to usually the CEOs and the presidents of the company, and a lot of times, that creates a negative opinion of these types of plans, and that's the last thing that anybody wants, right? These are there for their benefit, not as to penalize anybody in the platform, whether it's your rank and file or your highly comp.
Yep, no, that makes a lot of sense. And then pivoting a little bit to for the advisors that are looking to learn more about their prospects using the Form 5500. How can they use it to find that non-discrimination testing failure when they're getting to know a client?
So a couple of ways in here, right? When you're looking at this and you're seeing what's on the screen and you're recognizing that there's a decent amount of corrective distributions, you're looking at this in proportion to the number of participants in the plan. And when you're seeing that, exactly that this is your C-suite or who this is that it's impacting the most. You also know that from our audience in here, from an advisory perspective, this is one of those giant light bulbs that should go off that says their current advisor might not be looking out for the best interest of the people that are really running this company. And I think that's often a good sales tactic to be able to go in and highlight something like this, explain, hey, there are other alternatives in here that we may be able to either eliminate this number or get this number severely reduced based on a few programs and ideas that we have, right? And that will entertain an audience to that capacity. But this is definitely a section of every 5500 when the due diligence is going on and the prospecting phase is happening that should be looked at. It generally will correspond, and I don't put a lot of stock in this, Nathan, you probably don't either, but in those ERISA scores that come out, I think that those things are all over the place, but there is some elements in there that make sense with how they run those calculations. This is a major contributor of that. In some cases, it's not usually, it could not be the client's fault, right? Or the employer's fault. It's just something that it happened that they really weren't able to prepare for or have the foresight that it would happen. And in those cases, they get a bad score for no reason. But this is definitely something that needs to be looked at, at the very top of the list for advisors that are doing their research on 5500 forms.
Awesome, thank you. Well, and let's touch on 403Bs just a little bit because I know we're tight on time with all the things we have to cover. So Nathan, what are you seeing out there as common issues for the 403Bs?
Yeah, I'll be super brief, but I'd say if you do one thing on your 403B client, it's the first bullet point right there, universal availability. Make sure that they're really following that. And the question you want to ask is if they're excluding anyone from being able to defer into the plan. And there are certain trivial categories that you can exclude, but you can't do something like exclude, if it's a school, you can't say, non-faculty staff can't participate. You can't exclude part-timers, just as a class. So, ask about that. Make sure that they aren't excluding people that they shouldn't, which causes them to lose, compliance with universal availability. That'd be the primary one I'd leave on that.
Perfect. Thank you. Well, and then most common audit findings, I know we touched on a lot of these, so you can read them here, but I have a question for Trey here. How long do you advise sponsors to keep plan documents, statements, testing, that kind of information?
I mean, ideally 6 years, right, is where we'd like to see them, kind of keep those types of records. That's where we have it, usually longer, but For something to go back and research that, or to have those types of information on hand, it substantially helps with any type of DOL or IRS audit, right? They're not concerned that there was mistakes made. They're concerned about that there not being processes in place or a procedure or some type of documented, account of what has happened. And so as far as maintaining, accurate records on there, that's highly important. Keeping those things organized, making it simple, only helps everybody involved on there to be able to keep the accuracy of the plan, not repeat past mistakes. Everything that's listed on here, most groups are somewhat guilty of to small capacities. It happens, right? Little things happen, but if there is a documented process and you can identify that and trace it down, that's going to do so much more repair than having to pay somebody to go in and find it and research that, and then have to do it again a couple years later because the documents weren't maintained. Plans change, right? Things happen. People move record keepers, they move TPAs, they change ownership, structure, plan documents, and there has to be accurate records of that. One of the biggest problems that we have sometimes with getting plans over is in just getting a hold of their signed existing plan documents on here, right? Their existing adoption agreement with the actual amendments that were made, right? Or the restatements. Those are very important records to keep. The service providers will maintain those, but in a lot of cases, they're not going to make it super easy to get a hold of. So that's something that an employer definitely needs to keep on hand. And really, from a documents perspective, the advisors should also try to maintain a copy of their own client plan documents just to have that. It can only do good things for them.
Yeah, 100%. So let's shift gears a little bit with hiring a quality auditor. And one of the takeaways from this session, you are going to receive a white labeled, like you can brand it with your logo, your contact information, and use it with your clients to help them find, good auditors. And we got a great one on the line with us, but literally the questions that you should be asking. So that's going to be one of our takeaways. But Nathan, can you please talk a little bit about the things that are really important?
Yeah, I'll be brief, but I think the primary things is obviously specialization. And we'll look at in a moment, just briefly at a slide that shows how basically the deficiency rates in audits go drastically down when you see an audit firm specializing. Yeah, this slide right here. So as you see, firms that are auditing more than 100 plans a year got a deficiency rate of about 12%. And then it just, the less specialization there is, the more, rocky these audits get. And you really don't want to have what's happened to a few of the clients we've picked up is the DOL decides to pick on some of these small cohorts, picks up the plan, looks at it, reviews the work papers, decides that the auditor didn't do sufficient work, rejects the filing. Now they've got to do the audit again. They pay for the audit twice. They've got to go through the filing again. It's a huge pain. So specialization is huge. But I would say also, especially like as an advisor, you refer an auditor in, how your client likes the auditor is going to reflect on you. And I would say one thing that I've been emphasizing is there's a lot of firms that have EBP practices, and they've got some specialists, and they may even have some very high profile, nationally known specialists. But the other question you want to ask is who's going to be on the team? What are their skills and characteristics? Because that specialist is not going to work on every audit, especially if it's not an SEC filer. Those specialists are going to be working on SEC filers. They're going to work on these complex plans with valuation issues and things like that. If you've just got a standard plain vanilla 401k plan, that specialist is not touching it. And so you got to ask who's going to be on that team. And a lot of times it's not going to be the top people in the firm. It's not going to be people even that are specialized. So even though the firm might have a so-called specialty, that's something to dig into. because that will really affect your client's experience. If you've got someone who does SOX work and corporate audits for 9 months of the year and then pops into 401ks in the summer, they're not going to deliver a great experience for your client. They're going to ask a lot of questions. They're going to try to audit it like it's an SEC client. They're not geared for it. And so
they have like a checklist. Like I've seen it. It's like a horrible long checklist that they just literally read line by line and not.
And 90% of it is not applicable, but they ask every single question anyway. Yeah.
And plan sponsor comes back like, where's this thing? You're like, oh my God, that doesn't even matter. Yeah.
Yeah. Or like, do you know you could get that from, your record keeper? You just download the report, So yeah, I think those are the two things I would really emphasize.
Awesome. Thank you so much. Well, and then anything else on this slide? I mean, I think the numbers really speak for themselves. This was pretty crazy to see. Very eye-opening on why specialization is important. Well, fantastic.
These numbers are based on the Department of Labor's audit quality study from a few years ago. There's a new one about to come out. So we'll see what the new numbers look like.
Great. Awesome. Well, we're running short of time and I want to make sure that we have enough time for any questions that the audience might have. You have our contact information right here on the slide too, but know that next week you will be in touch with your standard wholesalers will be in touch with the Auditor RFP sample that you can white label. We'll also provide a TRA map for you to get in contact with your local TRA TPA counterparts. If you know your standard wholesalers already, feel free to reach out. Or otherwise, we'll be in touch